Good day, participants. Today we would be talking about claims and claim settlement. This particular topic is covered in chapter number 15, which is implementing and reviewing claims insurance. This chapter, claim settlement, is in chapter number 18. So we have claims and claim settlements as subtopics in both of these two chapters. So we would be talking about this subtopic separately because this requires some deep study about this particular topic. First of all, while talking about claims and claim settlement, we should understand what basically means by claims. Claim is a demand that the insurer should meet by paying an adequate sum assurance at the specified event. In the case of life insurance, those specified events are when the risk takes place during the tenure of the policy, number one, and number two, at the end of the plan, that is at the maturity, if it is an endowment plan. So therefore, those would be the specified events. So whatever has been promised by the insurer, that has to be committed. So that the insurer has to redeem that money which has been promised to the insured. So that fulfilling of that process is known as meeting the claims requirements and claim settlement. So therefore, insurer has to perform his part of the contract, settle the claim, but before settling the claim, the insurer has to ensure that all the requirements meeting out the claim have been fulfilled by the insurer. For example, the insurer have to complete certain documentation process. It has to ensure that the specified event has taken place. In case of life insurance, if it is a death claim, then death has taken place. If it is a maturity, it has to ensure that that maturity period has come. So it has to see that the conditions, terms and conditions are being complied with. Now, next we will see that so basically there are three major kinds of claims. One is death claim, other is maturity claim, and the third one is survival benefit claim. So therefore, in all these kind of claims, insurer has to check whether the insured event has taken place and what are the obligations assumed under the contract. So now next, one by one we will see what these claims are all about. We will study about the maturity claim, what maturity claim is all about. Maturity claim happens when the tenure of the plan ends, that is when the maturity date has come. For example, the plan is of 20 years at the end of the maturity period. So therefore, this action is initiated by the insurer itself. The insured need not approach the insurance company, yes, my maturity period has come, because that date is with the insurance company. So this action is initiated by the insurance company itself, and the insurance company on its own send claim intimation to the insured, and normally it is sent 2 to 3 months in advance before the actual maturity date. So in order to comply with the maturity claim, the insurance company has to comply or has to ensure some terms and conditions. Number one, it has to, for maturity claims, it has to ensure, number one, that there are no assignments in the policy. No assignment. No assignment means that the policy has not been assigned to anybody else. Because if the policy is, say, absolutely assigned to another person, that means the claim would be given to the assignee. So it has to ensure this. Number two, it has to ensure the identity of the policyholder, that the money is being given to the same person. Sometimes the address changes, so it has to ensure that it's going to the same person. So therefore they also ask for, sometimes they ask for another age proof, they ask for an ID proof of the person to whom the maturity benefit is going to be given. So therefore, sometimes age has again to be ensured and admitted. Previously, insurance companies used to cross-check the age at the time of maturity period, but nowadays this process is no more in vogue. Then they have to ensure that all the premiums are paid in the policy. In case in the last leg of the insurance plans, say 1 or 2 premiums are not paid, then the policy is not lapsed because the maturity date has arrived. They just deduct those premiums in default. And then the most important thing, that they have to ensure that the discharge form is filled up and signed by the insured person. So they send the discharge form in advance. It's a kind of a receipt, payment receipt. So in the case of insurance companies, this has to be signed in advance. So after receiving all these documents, then they process the claim, and accordingly next the claim check is sent. So therefore, insurer is expected to make the payment on the maturity date. So while this processing takes place prior to the actual date of maturity, so it's ensured that it reaches the person at the stipulated time. And sometimes the insurance companies can also send post-dated check. Suppose they are sending, say, a fortnight before the actual maturity date, so they will send the check of that actual date of maturity. Many times it may happen that the original policy may get lost. Yes, this is another important factor. Original policy has to be submitted in the case of maturity claim with the insurer. So original policy is also to be submitted. Sometimes it may happen that the insured may write that he has lost, or it is not untraceable. So in that case, they have to ensure that there is no bona fide intention behind it. Bona fide intention in the sense that it has not been pledged as a mortgage to some other financial company or other bank. So in that case, some other people may come to lodge their own claim. So this they have to ensure. But in this case, there is no need for at the most they can ask the person to give an indemnity bond. So that indemnity bond can be taken. So in case there is some other claimant, so I will forego my claim and all these things. All those legal formalities would be done. But there is no need to issue another policy. Normally, if during the course of the policy, if the policy is lost, then another policy would be issued, a new policy. But here there is no need, because it's just the end of the plan. Right. So this was about the maturity claim. We will talk about the survival benefit claim first. Then in the last, then we will be talking about the death claim. Now talking about survival benefit claim. What is survival benefit claim? And what is the difference between maturity claim and survival benefit claim? See, as you participants have studied the various types of plans, you know that in any kind of endowment plan, at the end of the plan, that is at the maturity period, the maturity money would be given. So that is the maturity claim. Whereas in the plans like money back plans, at periodic intervals, some amount of sum assured is given, some percentage of sum assured is given. So basically that is known as a survival benefit claim. And that is given only on the survival of the insured person. So survival benefit, we say it is paid during the currency of the policy, but before the date of maturity. So its procedure is more or less similar that to maturity claims. Here also action is initiated by the insurer itself, and they send post-dated check for that particular date on which it is the survival benefit is due. And in case here also, in case policy is lost, so the claim is settled on the basis of indemnity, and in the meantime new policy is also issued to the person. So therefore, some of the insurers may also call the original policy, because they do the necessary endorsement of the policy that yes, one survival benefit paid. Similarly, at the time of second survival benefit, again they will make an endorsement. But these days, some companies do not insist on calling back the original document, because this process may take a lot of days, and sometimes the policy may be lost in between in the postage and all. So therefore, it depends on the terms and conditions of the, or on the precedents taken by a particular insurer. So therefore, sometimes it may happen that survival benefit may become due, but before its settlement, the survival benefit is, for example, a survival benefit has become due in a policy, and the life assured dies in the meantime. So what will happen? To whom the survival benefit will be given? In that case, survival benefit, there is the precondition of paying survival benefit is that the date on which survival benefit becomes due, on that particular date, the life assured should be alive on that date. If the life assured is alive on that date, that means he is liable to get the survival benefit. But he died before receiving the survival benefit. So in that case, the survival benefit would be paid to the legal heirs of the person. It won't be given to the nominee of the life assured. So this was about the survival benefit claim. Now we will talk about the other part, which is the death claim. So the procedure in a death claim is more complicated than of a maturity claim, because here the insurer has to be more cautious in giving the claims, because they have to ensure that the claim should not go to a fraudulent person. Sometimes it may happen that a person has not died and he has vanished somewhere, and the claim has been lodged in his name. So those kind of cases they have to ensure, because they have to ensure that the policy's benefits are equitable to all its policyholder, because it's sharing of losses. So therefore, they have to establish that the event has happened and the identity of the claimant has to be established. So the first process of death claim is that there has an intimation of death of life assured has to be sent to the insurer, because then only they will start the processing, otherwise how they will know. Now here also, number one thing is intimation. Number two, sometimes, now who can give this intimation? Now this intimation can be given by any of the kith and kin of the deceased person, number one. This intimation can also be given by the agent who had sold this plan. This intimation can also be given by any official of the life insurance company in whose knowledge this event has come to the notice. And in some cases, the insurer on their own can also initiate the death claim proceedings on the basis of some reports, say some news report in the newspaper. Sometimes it may happen that this particular news was there in the newspapers. Sometimes there are accidents, sometimes there may be murders, sometimes there may be some obituary columns. So from that, if the insurer come to know about that identity of the person in their show, so insurer on their own can start the proceedings. They need not wait for a formal intimation to come to them. Now this intimation letter should consist of the name of the life assured, the policy number, the date of commencement, etc., so that they can track this is which policy. Right. So now next step is that they will start processing of the claim. Now what are the prerequisites of settling the death claim? Number one, after intimation they will start the proceedings. So the claimant needs to submit the policy documents. Then, in case the policy is assigned or reassigned to someone, then assignment, deeds, if required. Then we would say the proof of age in case it was not admitted before. Although this procedure is now no more in vogue, but in previous times, it was not a mandatory to admit the age at the commencement of the policy. So insurers used to admit the age at the time of claim, either maturity or death. But nowadays, this process is not insisted upon because there is no need for that process. Then they would need a certificate of death by the concerned municipal authorities. One needs to get a death certificate from the local municipal authorities. Then next they would need a form of discharge. Now who will sign this form of discharge? This will be signed and filled up by the nominee of the person to whom the life insured had made the nominee. Now what happens if the life assured dies due to an accident? Now in the case of natural death, okay, certificate of death is sufficient. In the case of an accident due to any cause, an FIR has to be lodged of that accident, so an FIR's copy has to be attached. So FIR in case of accident a copy of first information report, then copy of PIR. PIR is police inquest report, that is police after inquiry police submits its report, and then a copy of PMR, which is post-mortem report. So these reports further have to be submitted if the claim is due to an accident, because sometimes the concerned person had taken an accidental death benefit. So in order to avail those benefits, these reports have to be submitted. Now, insurer has to ensure that there should not be any suppression of the material facts. Now, there is a rule that if the claim has occurred within 3 years of the commencement of the policy, so therefore in those cases the insurer have to conduct a separate investigation or a separate inquiry, because they have to ensure that maybe the person has died due to, especially in cases of natural deaths, maybe the person was suffering from some disease before taking up the plan. So first 3 years after the commencement of the policy, that inquiry is, it's a so-called inquiry where just the insurer has to ensure that there was no suppression of material facts at the time of taking of the policy. So in case of death due to some illness, they have to take the statements from the hospital or the nursing home which this person might have attended. So the report of the medical attendant who had attended on this person, statement from the hospital, because this person will confirm that this person was suffering from this disease and this treatment was going on since the last so many years. Sometimes it happens that all these facts come out with the insurer that this person had been taking the treatments in the past, say, 7 years, and whereas this plan was taken only last year, and the insured person never revealed in the proposal form that he was suffering from this particular illness. So it would be a direct suppression of material facts. So in that case, the claim can also be repudiated. Repudiated means that the claim can be refused. So then sometimes in such cases, there can also be a statement from the person or persons who had attended the last rites of this person. So they can act as witnesses. Yes, we have attended, it was the same person who had died. Then sometimes if the person was employed, sometimes if any of these witnesses are not available, then there can be another option that there can be a statement from the employer where this person was employed. So when we were talking about accidents, in case of say road accidents and all these FIR, PMR and PMR are insisted upon. What happens if the person has died in a plane crash, for example? So in that case, if the person has died in a plane crash, then the list of the passengers who were traveling in the plane, that list has to be seen, and then accordingly the accidental claim can be settled and the identity of the person can be established. In case the person was in a sea voyage, was traveling in a ship, and the ship had, let's say, sunk, so the body was not found. So these questions arises when in an accident the dead body or the dead remains of the person are not found. For example, in an air crash, I said. So in an air crash, we say the passengers list or the crew list, whatever is there, which would be available from the concerned airport authority. In the case of ship, there is a log report of the ship. Log report consists of all the persons who had boarded the ship, all the inventories available which were there in the ship. So this log report would be resorted to. Then in the case of war, in defense, a person was employed with defense services and then person was untraceable. So the unit commander's report would act as proof, as an identity of the person that yes, the person had been killed, although the body was not found. So these are several rules and regulations. Now let's talk about suppression of material facts. When we are talking about suppression of material facts, the onus of proof basically lies on insurance company, because under section 45 it says that insurance company has to prove that there was a suppression of material facts. So they have to come out with real proofs in order to repudiate a claim. So therefore, within 2 years, the death of the policyholder is within 2 years after the policy was effected. The company can avoid the liability after proving that there was a suppression of material facts by the life insured at the time of taking of the policy. But after the period of 2 years is over, now insurance company has to prove fraud behind the verified intention. They have to not only prove just the suppression of material facts, they have to prove that this suppression of material facts was intentionally done and there was some intention of fraud. So the status is slightly different from that. So systematically done, these inquiries could prove some data to tighten the underwriting standards for the future. Right. So this data might also give some important information about any future selling of the plans. Now, what happens in the case of death? To whom the claim is given? As we know, it is given to the nominee. Right. So nominee, in case if the nominee has also died in the meantime, so to whom then the claim would be given by the insurance company? In that case, insurance company will give this claim to the legal heirs of the person. People will have to prove that they are the legal heirs, and accordingly, practically what happens, the legal heir would nominate one person as their representative, and that representative will take the claim on behalf of the legal heirs of the person. And in case of any dispute among the legal heirs of the person, so in that case, unless and until the dispute is settled, say by the courts, the insurance company will not settle the claim, or insurance company would deposit this claim amount with the court, and accordingly then whenever the case is settled, then court will further distribute this claim. But in the meantime, insurance company will be exonerated of its responsibility of giving the claim. They will deposit this claim amount with the court. Now, sometimes there can be situations when, though the policy has lapsed and nothing is payable, yet insurer pays a death claim. For example, the policy was, say, taken for 20 years and in between the policy has been paid for 10 years. So, whether the claim would be payable or not payable, let's understand it by some numerical problems. We'll be doing some certain numerical problems to understand how do we settle down a claim and what is the actual amount given, how the bonus is calculated in a maturity claim or in a death claim. So participants, talking about claims, we have studied about the theory of the claim. Let's calculate a few numericals and try to understand how do we calculate the claims. First of all, let's understand how do we calculate a maturity claim. Now, for example, there is a policy which is a participating endowment policy, where the sum assured is, say, rupees 2 lakhs. It was taken for a term of, say, 20 years. The vested bonus in this policy is, say, rupees 50 per thousand. Or I would say, let's say it's not vested bonus, this is the reversionary bonus. Reversionary bonus. Then let's say there was an interim bonus declared as rupees 60 per thousand. Then the PDP benefit sum assured was for rupees 50,000. Accidental death benefit sum assured was for rupees 2 lakhs. So we have to calculate the maturity claim. Let's say this is the problem. So here, if the same question is given in a test or in an exam, how do we attempt this question? Now, first of all, we'll see that what kind of claim is this. Is this a maturity claim? So clearly the question states that this is a maturity claim. So maturity claim means it's a participating endowment policy. So that means the full sum assured would be given, number one. Number two, since it's a participating policy, we will have to see what are the various bonuses accrued in the policy. So bonus has to be added to this. What else? It's a maturity plan. We have to see what type of policy is there. If it is a double endowment policy, then in a double endowment policy, the sum assured is double at the time of maturity. Since it's not a double endowment policy, so nothing else has to be given. Because ADB, accidental death benefit, sum assured is given only on the death by accident. Similarly, permanent disability benefit is given only if the person becomes disabled. So nothing of that sort happens. So although there can be a lot of data given in the question, but we need not fear about from that data. So we just have to calculate 2 lakh is sum assured, which would be given. Then bonus we have to calculate. Number 1 is reversionary bonus. So first part we will calculate reversionary bonus is 50 rupees per thousand, means on a sum assured of 1000 rupees, 50 rupees is the bonus per year. So on a sum assured of 2 lakh, the bonus would be 10,000 rupees per year. And the plan was for 20 years, so that means multiply 10,000 into 20 years. So this is 2, again 1, 2, 3, 4, 5. So this is 5. So 2 lakh is the bonus, reversionary bonus, which you call. So reversionary bonus is 2 lakh plus 2 lakh. Second type of bonus is interim bonus. Now we should know what interim bonus is. Interim bonus is given only one time in the final year of the policy. Sometimes, because the valuation is done after 31st of March, or at the end of the financial year. So by the time the valuation results are out, it's say August end or September beginning. So during this intervening period of 1st April till the bonus are declared, there would be some other claims which would be maturing. So how we will declare the bonus of that particular year? So that bonus which is declared on the basis of last year's valuation is known as the interim bonus. So this interim bonus it will be given only one time. So don't make a mistake of multiplying it by 20 years. So we must know what the interim bonus is. So it is 60 rupees per thousand. So on 2 lakh rupees of sum assured, this would be 6 to the 12, 1, 2, 3. So this is 12,000. So 2 lakh plus 2 lakh plus 12,000. So the total claim would be 4 lakh 12,000. So this would be the answer. So this is how, so in the maturity, while calculating the maturity claim, we have to see what type of policy is it. Sometimes they can give some tricky question. It's a non-participating endowment policy. And they can write that such and such for the bonus declared by the company. So these bonuses were declared by the company. It could be for some other plan. But for this plan, since it's a non-participating plan, it is not eligible for bonus. So sometimes there can be some tricky language which is meant to dodge the participant. So therefore, we have to see what type of plan is there, what kind of bonuses are there. Sometimes there can be another form of bonus which is known as terminal bonus. Every, say, 10 years. Terminal bonuses are those bonuses, sometimes terminal bonuses is given only at the maturity of the policy. That is a final bonus. Sometimes terminal bonus is also known as final bonus in some cases, which is given at the end of the policy. Some companies give terminal bonus after every 10 years of the completion of the policy. That is just to give an incentive to the policyholder. So in this case, we will say it's a 20-year plan, so it will be eligible for 2 terminal bonuses. So they will give some rate terminal bonus, say at the rate of 100 per thousand. So we should know per thousand sum assured 100 rupees. So that means we don't have to multiply it by 10 years or multiply it by 20 years. So 2 times, every 10 years means there would be 2 10 years tenure in this policy. So in case such kind of option is also there, then we will add another bonus. The third kind of bonus is terminal bonus. So which is 100 upon 1000 into 2 lakh. So this is 1, 2, 3, 4, 1, 2, 3, 4. So this is 20,000 bonus. But so there will be 2 terminal bonuses into 2, so which is 40,000. So if this is the claim, we will further add say 40,000 in this. So the total claim would be 4 lakh 52,000. So this is how we should calculate the maturity claim in a particular policy. Now let us see how do we calculate death claim. Now to calculate a death claim is little more tricky, and sometimes it becomes complex in case the policy was lapsed. First of all, we will see a normal policy in which the premiums, the due premiums are paid in time. Let's consider the same example. These were some of the bonuses which were declared. Let us say the question further states that insured, the life assured died on. Now here they will also give what was the date of commencement of the policy. Sometimes in maturity claims also they may give what is the date of the commencement, and they will give the date of maturities. Accordingly, sometimes they may not give this term directly. You have to calculate how many years policy was this. So in this case, they have to give the date of commencement of the policy. For example, the date of commencement of the policy was, say, 16/11/1999 was the date of commencement of the policy. The policy was taken for 20 years. Now they say that the life assured died on, say, 21st February 2006. Now calculate due to heart attack. Calculate the death claim in this case. And they will also write the premium. They should also write what is the mode of premium payment. Say the mode of premium payment is half yearly, and the premium half yearly installment was, say, 8,000 rupees on a particular age. So calculate the death claim payable. So we have to see, we have to have one more information, that when was the last premium paid in this particular case while calculating. So this, the premium due in November 2005 was paid on, say, 6/11/2005. Now this is the data which we have got. So in this case, the first step which the claim department will take, let's say the same data has come to the claims department. Now they have to process the claim. So first of all, the first step is they should find out what is date of last premium paid. In insurance parlance, we call it just LPP. What is the LPP of this policy? Last premium paid date. Last premium paid date is 6/11/2005. Now this is a plan which has got modes of, which has got half yearly mode. So that means the premium are due one in November, on November 16. Then after 6 months, November, then December, January, February, March, April, May. The second premium every year is due on May 16. Then one gets 1 month grace period also in the case of half yearly mode. So basically he has paid this premium. The premium which was due in November was paid on 6/11. He paid 10 days earlier. But basically on this date we will see that we will write the due date. So due date was, that means that this was the due date of this premium which was paid. So last premium paid, will write the due date of the premium paid. Now the formula is you have to add the mode of the premium payment. The mode is half yearly. Half yearly means every 6 months. So we have to add 6 months in it. Add 6 months. Now the date which we get is 11 plus 6 is 17, 2005. So basically it's 17 months. We will send 12 months over here. So it becomes 2006, and this becomes 5, and this becomes 16. So 16 is the due date for the next premium. So in insurance parlance we call it first unpaid premium. In insurance language they call it first unpaid premium. Next due date which was not paid, because premium was paid only for this due date, so this becomes the next unpaid premium date, that is first unpaid premium date, which is known as FUP in insurance parlance. 16/5/2006. Now, as per formula, we subtract the date of commencement DOC from this 16/11/1999. We will come to know that for how many years the premium has been paid. You have to reduce 6 months from 7 years. So this is 6 years and 6 months. So the premium has been paid for 6.5 years. We paid the premiums. Okay, fine. We will study why we are calculating this, how many years premium has been paid. Now, sometimes we may get very complicated cases also. Sometimes we may get cases where the policy was lapsed. Now, this person died in February 2006. His next due date is on 16/5/2000. So he has died before the next premium's due date. But still, sometimes we may come across certain cases where the premium of the last, say, 2 or 3 years was due. So in that case, whether to pay the death claim or not. Now, some insurance companies have got some special rules for those cases, especially Life Insurance Corporation of India follows certain rules, and it pays death claims in a sympathetic manner, or in other words, in a broad-hearted way. So they have a rule. We'll be talking about that rule, but let's first solve this question. So here, in order to make it simple, let us say, let's make a diagram. This particular arrow, I have made 2 arrows. This particular arrow, I will call it as FUP point. This particular arrow, I will call it as last date of claim concessions. There is a concept in insurance, life insurance companies, with some insurance companies, they give claim concession period also. Although not every company is giving this claim concession period, but some companies do give such claim concession period. Now, the formula is, if the date of death, DOD we call it, date of death, occurs before FUP, then what will be given to the claimant? He will be given sum assured plus bonus, if any, plus or minus outstanding premium. We will see some more interesting cases where the premium would be deducted, where the premium can be given back to the customer also. But this scenario can arise only if the death occurs before FUP. Now, what is the last date of claim concession? Actually, this scenario, if the death occurs after FUP, that means this scenario would happen only in the case of lapsed policy. If the policy is not lapsed, that means if the death has occurred well before FUP, that means there is no question of stopping the claim. One has to just see what are the outstanding payments. But in case the policy was lapsed, so one has to see if the policy was lapsed since last 6 months or 1 year or 2 years. So this one has to see. Life Insurance Corporation rule says that if death occurs within 6 months of the date of lapse, or we can say date of FUP here, if it occurs within 6 months, and for which policies? The policies which have at least paid premiums for at least 3 years. For them, to make it more simple, I will make it more simple. Let's not confuse it with this. Life Insurance Corporation rule says if the policy has run for at least 3 years, then they will get a claim concession of 6 months. Claim concession. That means if, in spite of lapsation of the policy, if the death occurs within 6 months of the lapsation, if the death occurs anytime, then within 6 months if it happens, then the full claim will be given. Similarly, if the policy has run for at least 5 years, then claim concession of 12 months will be given. Let's make it more simple. Now this policy has run for more than 5 years. So that means it is eligible for a concession of 12 months. So that means from FUP. So FUP date is, here we have calculated FUP pay date 16/5/2006. So 1 year to this, it would be 1 day before. So it will get claim concession up to 15/5/2007. So even if the date happens after this date, this person will get, here in between this period and this period, this person will get full sum assured plus bonus, only minus outstanding premium, because definitely there will be some outstanding premium here after FUP. Now what happens if the death takes place after this concession period is over? If the DOD is here, then the person will get just the paid up value, that is the reduced sum assured value. The paid up value on that particular date would be calculated and that would be given to the claimant. Now, in this particular case, the date of death is 21/2/2006. So it is happening before this FUP. So that means the claim would be given according to this formula. Now let's calculate the claim amount. He will get sum assured, which is 2 lakh rupees. Further, he will get the bonus. Now bonus, for example, they have written like this in this fashion. So 50 rupees, number 1, 50 rupees per 1,000 to 2 lakh for 6.5 years. How do we calculate this 6.5 years? Normally in these cases you will not get such questions, you will get an aggregate figure of the bonus. So this is the bonus which was eligible for this policy. Anyway, if such question arises, then we will take only 6 years, 6.5 years normally. These policies do not take, because they give interim bonus for the next 6 months. So into 6 years we will calculate. Number 2, if there is interim bonus, so that will be given. Even if they have written terminal bonus every 10 years, so this policy is not eligible. So they will write, let's say terminal bonus was, interim bonus was 60 rupees per 1,000. So this is given only one time. So we will calculate this. So this was about bonus part. So we will take the total. Now we have to see whether any outstanding premium, just because the premium of due date was given and the death took place before FUP doesn't mean that there will not be any outstanding premium. There could be. So now this is a very tricky situation and very interesting situation also. There is a formula for calculating the outstanding premium to make it very simple. We need not rack our minds whether, because there is a concept of policy here in this case. So there is a very simple formula for this. We have to find the next policy anniversary date falling immediately after the date of death. The next policy anniversary date immediately falling after the date of death minus the FUP. You will get the outstanding premium. Let's understand this. Next policy anniversary date. See, policy anniversary, like we celebrate marriage anniversaries, birth anniversaries. So anniversary, normally any kind of anniversary would fall on a particular day and on a particular month. The years will go on changing. So this particular date, by policy anniversary, we mean the birth date of the policy, when the policy had commenced. The policy's commencement date is 16/11. So that means every year the policy anniversary will fall on 16/11. Only the year will change. So first of all, next policy anniversary date is 16/11, but what would be the year? Falling immediately after date of death. So after 2006, 21 to 2006, what is the policy anniversary date? 16/11? 2006 only. Immediately after this. So we will write this date. Number 1 minus FUP. FUP we had just calculated 16/5/2006. This is year, this is month, this is date, this is 0, this is 6 months. So that means outstanding premium is of 6 months. So that means out of this total claim which you have calculated, you have to deduct a premium of 6 months, which is after the installment 8,000 rupees has to be deducted from the claim. Now apparently it was looking that there would be no outstanding claim, but we have to apply this formula. Basically, this policy anniversary date means that the person is supposed to pay the premium from 16/11/2005 to 15/11/2006. Had it been an annual mode, the person would have paid the full annual installment at the beginning of the year. Now since this facility is given to the person, the quarterly premiums or half-yearly premiums or monthly premium, doesn't mean that the person's liability is not there to pay a full year's premium. A person's liability is to pay a full year's insurance premium. So therefore, if he has died within that policy year, this is the insurer's right to take a full year's premium at least. That policy year's premium. Therefore, the second half of this policy year has to be taken by the insurance company. So this is how we calculate the claims. You will get several other dates and all where the date of death will fall here. So accordingly, you have to calculate according to this formula. So by this formula, it becomes simple. You just have to apply your mind. The date of commencement, date and month would be the same. The year you have to apply after the date of death. So I hope participants, you would be able to solve the various numerical problems given, and the more practice you do, the more comfortable you will feel. Thank you very much.